Hey, welcome back. And in today's video, we're going to talk about PayPal. And if you're on YouTube or Twitter, you'll know that a lot of retail investors really like PayPal right now, especially as the stock has dropped over 80% from nearly $300 down to below $60. And with many investors rushing in to buy this stock now, I think it's important to not get caught up in the FOMO and take a step back to look and see if this is really a company that you want to be invested in, or whether or not it's a value trap. So in this video, let's go through it together and see what PayPal's competitive advantage is, or moat if they have any, and all the other aspects of their business that make retail investors really attracted to this investment right now. And a quick disclaimer is, I'm not going to be coming at this company like a short-term trader would, where maybe it does see a 100% rally back to 120 or 130. I don't know what the short-term movements of the stock will be, but what I'm trying to see is whether or not it is a really fundamentally sound company with a long runway ahead, and if it's a company I would want to be in for the next 10 or 20 years. And this isn't to knock anybody's trading style or investment thesis behind this company. That's just my individual approach that I'm comfortable with, and so that's how I'm going to do my research and evaluation of this company. So with that being said, let's get right into the first point. Does PayPal have a moat? Now, I think this is an important first step when you're evaluating a company, because if a company does not have a competitive advantage, or like some people like to say, a moat, then what's to stop another company in from coming in and stealing their lunch, and subsequently you bag holding their stock? Now, I'm no expert on the inner workings of the financial payment industry, so it's hard to understand the small nuances of what makes PayPal better or worse compared to something like Stripe or Adyen or many other companies that sell these types of services. However, what I can do and what I have done is sought other people's opinions who work in this industry and who are making that choice for themselves as small business owners or anyone who needs to use their own payment processor, and see what the pros and the cons are to the many different options that are out there. Now, one of the reasons I found that many merchants go with Stripe over PayPal is because of their fee structure. Now, Stripe has a very simple 2.9% plus 30 cents per online transaction payment structure. And there is a little discrepancy between that and the in-store payments, but for the most part, those are the only two main categories. Now, Stripe has a pretty simple payment structure, but if we look here, PayPal has a far more complicated fee structure. There are many different fees and different fixed fees as well. We have PayPal checkout, PayPal guest checkout, QR code transactions, $10.01 above, and then $10 and below. QR code transactions through third-party integrators, pay with Venmo, send, receive money for goods and services, and the list keeps on going. And it all adds up to be a far more complicated, opaque fee structure for a small business owner who maybe just wants to set up online payments and doesn't understand all of these complicated, different types of transactions and just wants one simple solution. Now, that isn't a super big deal. PayPal has a really trusted name, and it takes more than just a slightly complicated fee structure to drive competition away. But what many businesses are really seeking is something that Stripe has. And what Stripe has is a tighter integration with the merchant and their business's logos and design language, as opposed to a pop-up window that then takes you into PayPal and away from the merchant's site. A lot of merchants really want you to have that seamless experience through the transaction, and PayPal kind of disrupts that experience. Now, they do have Braintree, and we'll get to that in a minute. Now, moving on, I want to discuss PayPal's brand power in this industry. And the reason PayPal has excelled for so long is the immense trust that customers have with their product, as it was one of the most prominent and first online payment processors and has a very reliable history. Therefore, it has gained a lot of trust when paying for stuff online, and a lot of customers recognize it as a trustworthy, reliable option when making purchases on a website that they may not feel comfortable ordering from. That being said, this brand power does seem to be eroding somewhat, and not because of PayPal's own mistakes, but because of the competition that is entering the market. Entrants like Apple Pay, Google Pay, Amazon Pay, Shopify, and many others have gained a great amount of consumer trust because customers already buy and purchase things with these companies. And I believe that this advantage that PayPal once had is now becoming commoditized due to the nature of their competition, being some of the largest, most trustworthy companies in the world. And no, these big tech companies maybe not be trusted in the sense of your privacy and data, but they definitely are trusted when it comes to purchasing something online and knowing that that payment process is going to be smooth, have the correct information, and that you won't have to worry about anything getting mixed up or being fraudulent. And as this brand power becomes commoditized, PayPal has to compete with these companies on a different plane, whether that be customization for merchants or adjusting their fees to be far more competitive. And if they choose to adjust their fees, they will most likely have to compress margins, making their business less profitable and obviously less rewarding for the shareholder. For example, this is definitely anecdotal, but when there's a payment option for Apple Pay, I always use it. Now, I'm deeply ingrained into the Apple ecosystem, and I already trust them with a lot of my data, including my photos, my files, my contacts, my text messages, and many other things. And I think that that is the same for people who use Google Pay. And the main point that I'm trying to get at here is that the trust that PayPal had to work so hard to get and maintain their position in the market is now being commoditized to all of these different companies that already have that trust for different reasons and can now enter this market and disrupt that competitive advantage that PayPal already had. Now, going back to the topic of customization for merchants and how that is more beneficial to other companies outside of PayPal, that isn't always the case, because a bright spot in their company is Braintree, and that's their unbranded payment processing unit. And this company competes directly with the likes of Stripe, offering very similar fees and products. Now, PayPal has owned Braintree for quite a while. In fact, they've owned them since 2013. And it seems as though they are just now starting to refocus on their Braintree product, as they see it as a large part of their business going forward. And many retail investors who really like PayPal as an investment are championing this as something that proves that they are not a slow-growing company anymore, and they're still innovating and coming out with new products and services. However, what I believe that this really illustrates is that PayPal has no discernible moat, as their products are easily replicable. Now, with that being said, it is a positive that PayPal is not stuck in their ways and isn't falling into the trap of being in an innovator's dilemma. But it should be acknowledged that if you have to keep up with other companies around you, because your main source of revenue is sort of being disrupted, then you don't have the most dominant position in the market. Now, digital payments is a rapidly growing space and will be for decades to come. But that doesn't mean that PayPal will have an outsized return within that market if their market share continues to drop and margins get competed away as competition continues to grow and their brand power gets slowly diminished. Now, moving on to their financials. It's always important to look at the financial well-being of a company when you're trying to invest in it. And I will say, the valuation does look very cheap right now. But whenever I hear an investor say that they are not investing because of their superior business qualities, but rather because it is so cheap right now, I tend to stay away from those companies, because I don't want to find some company that is going to be a good trade for the next 6 to 12 to 24 months because it's so incredibly difficult to time the market. I just want to find very dominant companies within industries that are growing and hopefully able to catch an S-curve or two. And I think that the way of trading is kind of a loser's game. Not because many people can't make money doing it, but because it is trading and it's not investing. And there's nothing against trading at all, but there is a distinction between the two. And many don't have the chops to do one or the other. And I personally am far more interested in finding companies that can compound for the long term, rather than just looking at some mediocre, undervalued company. Now, that's not to diminish any of the hard work that the people at PayPal and their management team have done, and the accomplishments that they've already achieved. But as an investor, you need to align yourself with what companies moving forward will be the best return on your money over the long term. And I think trading in and out of a company that seems to be going through a lot of turmoil right now, and by my analysis, has no real competitive advantage in an industry with massive competition by the largest companies in the world, I just don't think that that's where I want to put my money. And I believe that it's already hard enough to find companies that have those superior business qualities and actually be right about that. And I don't want to add another variable of getting in at a good price and then getting out at an even better price. Some people will definitely be able to do it successfully, but there will be a lot of people who will try to replicate that on maybe other companies that aren't PayPal. And they'll lose a lot of money, a lot more than they gained during this PayPal run-up, if it even happens. Now, it is true that PayPal is trading at near all-time lows in accordance to their earnings multiples. And this can present a decent retrace back to the mean and could land anywhere from $100 to $120 and above, earning you more than 100% return. And that's nothing to shy away from. That is a very impressive return if you're able to capture that. But I'd rather spend my time finding companies that I believe will outperform for the next 10 years, rather than waiting for the market to find out that this company is undervalued and take it back to the mean, especially within the industry that I've outlined here in this video. Now, in conclusion, many traders might make a good return off of this, but I think unless clear competitive advantages emerge that can differentiate PayPal from other payment processors, I'll be sitting this one out. Now, that's all I had for you in this one. Thank you for watching. I'll see you in the next one.